Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, February 9th. The fourth quarter real GDP change was not as bad as expected, only because the change in inventories was larger than expected. Inventories added to GDP. Excluding inventories, real GDP fell at a 5.1% annual rate. The trends in the major components of GDP do not augur well for the first quarter. Consumer spending, which is real personal consumption expenditures, fell at a 3.5% annual rate. This followed a 3.8% annual rate in the third quarter. The level of spending enters the first quarter below the fourth quarter average. So even if consumer spending is flat on a month-to-month basis in the first quarter, the average for the quarter will still drop at almost a 2% annual rate on a quarter-to-quarter basis. More concerning is the accelerating rate of decline in business investment. Fixed business investment, which excludes inventories but includes equipment and software and non-residential investment in structures, fell at an alarming 20.1% annual rate. It was up at a 0.4% annual rate in the third quarter. Businesses are cutting back sharply, not just in terms of employees, but also in terms of investment. This will not turn quickly, no matter how much money is pushed through government agencies via the stimulus bill. There is virtually nothing in the bill to promote private business, just the hope that government spending on infrastructure and the hiring of policemen will lead private business to buy more from Cisco. Residential construction also took a turn for the worse in the fourth quarter. It fell at a 23.6% annual rate. The good news here is that housing has dropped so low that even a sharp decline now produces only a small impact on the overall GDP change. One of the most alarming aspects of the GDP data, however, was the drop in trade. Exports fell at a 19.7% annual rate. Imports fell at a 15.7% annual rate. Trade is essential to the health of the world economy. These data reflect the weakness globally. Government and inventories added to GDP but don't reflect underlying strength in demand. First quarter real GDP is likely to drop at a 2% to 3% annual rate simply because the monthly levels start below the fourth quarter average. A larger drop in the 5% range will occur if further pullbacks in investment and consumer spending are seen, unless inventories swing again, which is unlikely. Further out, the outlook depends on how the private sector responds to the mayors and governors across the nation handing out new contracts to repave roads and build new senior centers. I'm Pat O'Hare for Briefing.com. Thanks for listening.